Your year's growth was smaller than a single month of saving. 4 steady years, and that's the return on all of it, which feels like a verdict and isn't one. So 5 short chapters on when compounding actually shows up. The 4th is the honest one, where the final decade never arrives. Every figure tonight is illustrative, a round number chosen to show a shape, never a forecast and never a promise. What you'll leave with is a fairer measuring stick, a way to open a flat statement and know whether you're behind or simply early. Those are 2 different things, and one of them is much better news. You know the moment I mean. A Sunday evening, a mug going cold beside the laptop, the statement open. 4 years of contributions that never missed, 4 years of not touching it, not tinkering, not panicking when the news got loud. And the growth for the year is a number you could earn back with 1 more transfer. It's tempting, sitting there, to conclude that something has gone wrong, that the machine is broken, or that you are. Neither. But to see why, we have to start with the picture almost everyone carries in their head, and why it quietly misleads them. Chapter 1. The shape of the climb. Most people, without ever deciding to, measure their savings against a straight line. Put money in, watch it rise steadily, arrive somewhere good. It's a reasonable expectation.
It's just not what compounding does. Picture instead a staircase built to a strange rule. Every step is as tall as all the steps beneath it combined. The first few are ankle height. You climb, and you have barely left the ground floor. The whole flight still looks like a doorstep. Then, near the top, a single step lifts you as high as the entire staircase managed before it. Nothing about the staircase changed on that step. You simply reached the part where its rule becomes visible. Let me put rough numbers on it, and I mean rough. Treat these strictly as illustration, a round figure chosen to show a shape, not a prediction of anything at all. At an illustrative 7% a year, money roughly doubles every 10 years. That comes from the old rule of 72. 72 divided by 7 is about 10.3. So say you set aside $10,000 and left it alone for 40 years at that illustrative rate. It becomes roughly $150,000, about 15 times what you started with. Now the interesting part, which is not the total, but the split. After 30 years, that same $10,000 has become about $76,000, which means the first 30 years produced about $66,000 of growth. And the final 10 years, 1 decade, the last one, add about $74,000. Read those 2 side by side.
30 years of growth, $66,000. The 10 years after that, $74,000. The last decade alone contributes more than the entire history preceding it and just under half of everything you end with. The first decade, meanwhile, contributes about 6% of the final total. 6% for 10 years of doing everything right. And notice what none of this depends on. It doesn't depend on 7%. At 3%, the doublings come slower. At 9%, they come faster. The property survives either way. The last doubling is always the largest single contribution, always bigger than everything that came before it, because that is simply what doubling means. That is arithmetic talking, and arithmetic doesn't have moods. So the question you've been asking your statement, how much has this grown, turns out to be the wrong question at year 4. On a curve shaped like this, the early number was never going to impress you. It wasn't supposed to. Which leaves something unresolved. If the ending arrives at the end, what exactly are the early years doing? Because they don't feel like they're doing anything. Chapter 2. The years that look like nothing. In the early years, your own contributions do essentially all the visible work.
The market's contribution is a rounding error, not because the market failed you, but because there is almost nothing there yet for it to work on. Take an illustrative saver. Call him Daniel, a hospital technician, mid-30s, who sets up an automatic transfer of $500 a month and decides, deliberately, not to watch it. $6,000 a year. In his first year, at that illustrative 7%, his balance grows by roughly what he put in, plus a couple of $100. Year 2, a bit more. The statement is, in every meaningful sense, a record of his own transfers with a small tip attached. There's a moment worth naming here, because nobody tells you it exists. Call it the crossover, the first year in which the portfolio's own return exceeds a full year of Daniel's contributions. The first year, the money out-earns the man. With steady annual contributions at that illustrative rate, the crossover arrives when the balance reaches roughly 14 times the annual contribution. For Daniel, that's around $84,000, which lands somewhere around year 10 or 11. 10 years of discipline before the money starts pulling its own weight for the first time. Sit with the arithmetic of what he experiences in the meantime, because it's the whole psychological problem in one line.
For a decade, if Daniel judges the strategy by its output, he will conclude that it isn't doing much, and in a narrow sense, he'll be correct, and in a broad sense, that conclusion will cost him more than any mistake he could make with an actual investment decision. He's standing in the flattest part of a curve that is behaving exactly as designed, and the only thing he controls during that stretch is the transfer. The transfer is not glamorous. It is a Tuesday. It is a bank notification he doesn't open. That is the entire job for 10 years. The honest scorecard for the first decade is a count, not a return figure. Did the transfer go through 12 times? That's the only variable in your hands, and it happens to be the exact one the last decade will eventually multiply. Which brings us to the person who doesn't make it to year 10. Not the reckless one, the reasonable one, looking at a modest number in the flattest part of the curve, in a month when something else needs paying. Chapter 3. The quiet cost of stopping. Because the growth is backloaded, quitting early doesn't cost you the balance you're holding. It costs you the far larger sum that balance was on its way to becoming. And the decision to stop gets made at precisely the moment the evidence looks weakest. We have real data on how often this happens, and it isn't rare.
Research led by Yanwen Wang at the University of British Columbia, with colleagues at Texas State and the University of Colorado, followed more than 160,000 U.S. employees. It found that roughly 41% of workers cashed out at least part of their retirement savings when they left a job. And of those who cashed out, about 85% drained the whole balance. 41%. That is not a fringe of impulsive people. That is a very large share of ordinary, careful workers, all reaching the same conclusion at the same point on the same curve. It isn't much. And they're right. It isn't much. That's the trap. At that illustrative 7%, money left alone for 7 years has grown about 1.6 times, a modest, unremarkable number, exactly as we'd expect from Chapter 1. Meanwhile, the final 10 years of a 40-year run would have added more than 7 times the original stake. So the person cashing out at year 7 isn't spending a small balance. They're deleting the last decade from the front of the queue. The withdrawal is priced in today's dollars, and the cost is priced in the decade that would have arrived last. There's a second kind of interruption, and it rhymes with the first. J.P.
Morgan Asset Management's Guide to Retirement, the 2023 edition, examining the S&P 500 from the 1st of January 2003 to the 30th of December 2022, illustrated what happens when you step out briefly. $10,000 left fully invested across those 20 years grew to about $64,800, call it 9.8% annualized. The same $10,000, missing only the 10 single best trading days out of 20 years, finished near $29,700, about 5.6% annualized. Half the outcome, 10 days. And the detail that makes it more than a curiosity, the same analysis notes that 7 of the 10 best days occurred within 2 weeks of the 10 worst days. The days you'd need to be present for are hiding inside the days you'd most want to run from. 2 different mechanisms, 1 requirement. Compounding concentrates its work in the final years. The market concentrates its returns in a handful of days nobody can schedule. What's being asked of you is presence, nothing more strenuous than that. So, treat an early balance as a seed, not a stash. Before you interrupt it, ask what you're actually spending, not this year's number, but the decade it was on its way to becoming. But I owe you the objection now, and it's the strongest one there is.
Because I've just spent 3 chapters telling you the last decade does most of the work. Which means, if you're listening properly, you've already noticed the exposure. What happens to someone whose last decade doesn't cooperate? Chapter 4. The decade that never arrived. This deserves a straight answer rather than a reassuring one, so let me name the counterexamples precisely. Japan. The Nikkei 225 closed at 38,915.87 on the 29th of December, 1989. It did not close above that level again until the 22nd of February, 2024, about 34 years. Not a rough patch, an entire working life. Someone who started saving at 30 into that market reached 64 before the index returned to where it began. The United States has a smaller version. The 10 calendar years from 2000 through 2009 are called the lost decade
because the S&P 500's total return across them was slightly negative, roughly -1% a year, dividends included. And holding household name companies is not an escape hatch. General Electric peaked around the summer of 2000, fell apart through the financial crisis, and was removed from the Dow Jones Industrial Average on the 26th of June 2018, after 111 years in the index, never having regained that 2000 high.
Citigroup fell so far that in May 2011, it executed a 1-for-10 reverse split. Its pre-crisis peak has not returned. Even the classic American recovery story is longer than people remember. The Dow's closing peak of 381.17, set on the 3rd of September 1929, was not regained until the 23rd of November 1954, 25 years. I want to add one piece of honest nuance to that last figure, because it cuts the other way, and leaving it out would be a small dishonesty. On a total return basis, with dividends reinvested and adjusted for the deflation of the 1930s, most analyses put the 1929 investors' break-even somewhere in the mid-1930s, far earlier than 25 years. Both numbers are true. They answer different questions. The headline measures an index level. The other measures a person's actual money. Still, Japan's 34 years is not a rounding error, and no amount of careful framing turns it into one. So what actually protects a patient investor here? 4 things, and not one of them is optimism. The first answer is to spread beyond one country, and it comes with a caveat that keeps it honest. At its 1989 peak, Japan made up roughly 44% of the MSCI World Index. A global fund weighted by market value still handed you an enormous Japanese position. Diversification softened that blow. It did not erase it.
What spreading across countries does reliably is ensure that one nation's lost decades are not your entire outcome. Spreading out only helps if you keep feeding it. Someone buying monthly through 2000 to 2009 was not really living the lost decade. They were accumulating shares at low prices the whole way and were fully positioned for what came after. The person genuinely harmed by a lost decade is the one who arrived with everything at the peak and then stopped. Then there's the one that actually governs the last decade, and it has a name: sequence of returns risk. A downturn matters far more when your balance is at its largest, which is exactly the last decade. Same percentage fall, a completely different consequence, purely because of when it lands. It's the reasoning people are reaching for when they talk about a glide path or about holding some portion in safe assets near the end. The shared idea underneath both is simple enough. A bad market should never be the thing that forces a sale. And the last protection is just honesty about the horizon. The backloaded shape is an argument for starting early and for planning to spend a portfolio across decades rather than liquidating it on one particular morning. Hold both truths at once then. The curve is real and no market owes you your decade on schedule. So you build the structure and let the faith be optional.
But structure doesn't touch the feeling, does it? Even with all of it in place, the flat years still land as a test of character you're barely passing. That part deserves its own chapter, and the answer turns out not to be about character at all. Chapter 5. The Widest Rings Come Last. In January 2014, the journal Nature published a study led by Nathan Stevenson of the U.S. Geological Survey, drawing on more than 670,000 trees across 403 species worldwide. The intuition it overturned was that trees, like people, slow down as they age. They don't. For the great majority of species, a tree's rate of mass growth increases continuously with size. The largest trees in a forest are laying down wood faster in a single year than they ever did as saplings. The study notes that one big tree can add in a year an amount of carbon comparable to what's stored in an entire mid-sized tree. The mechanism is completely unglamorous. More leaves means more surface catching light. The old tree isn't trying harder than the sapling, and it isn't more virtuous. It just has more of itself to work with. That dissolves something worth dissolving. The sapling's slow decade was never a failure of will. It was a leaf area problem. Capital behaves the same way.
Early money is slow because there isn't enough of it yet to generate much, and no amount of conviction or research or discipline changes that arithmetic by a single dollar. Patience here is just the absence of interruption, nothing you have to heroically summon, which is precisely why it's something you can actually sustain. The most studied investor of the modern era shows the same shape from the far end. Warren Buffett has been investing since childhood, roughly 8 decades, and the overwhelming majority of his net worth arrived after his 60th birthday. The lesson there is duration, and duration only, not stock picking, and certainly not a template for anyone's returns. He was good early. He was enormous late. Those are two separate variables, and the second one is mostly just time. So you can retire the idea that you're being patient. You're not performing a discipline. You're declining to interrupt something that needs time to accumulate enough of itself to work with. And that changes what you should be looking for on a Sunday evening. So when you next open that statement in the flat years, and the year's growth is again smaller than a single month of saving, try changing the question. Not, is this working? You can't see whether it's working from inside year 4, any more than you could judge the height of a staircase from its second step. 5 chapters ago, I promised you a fairer measuring stick, and here it is, and it's smaller than you'd expect. Is the transfer still going through? Are you still here? That's it. That's the measurement. The arithmetic has already decided that most of this arrives late, the last decade carrying more than the 30 years before it. And it has also decided that the only way to be present for the late part is to be unremarkable for a long time first. There's a real kind of relief in that, and I hope you feel some of it tonight. It means the number that deflated you was never a judgment on your choices or your timing or your character. It means you're not behind. You're early, which is a different thing entirely, and much better news. The forest never asks the sapling to hurry. If something in here landed, I'd be glad if you subscribed. This is a slow channel, which seems about right. And if one idea stayed with you, the staircase, the crossover year, or the honest reckoning with Japan's 34 years, tell me in the comments which one it was. I read them.